Welcome to my channel. I'm the cover call guy, and my goal is to create a portfolio that yields me $120,000 per year. Right now, I yield about $72,000 a year, $6,000 a month, almost $1,400 a week, and about $200 per day. Legal disclaimer before we start this video: this content is for information and educational purpose only and should not be considered financial, investment, or tax advice. I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed on my own and may be incorrect or incomplete. Investing and trading involve significant risk, including possible loss of principal, so please always conduct your own due diligence and consult a qualified licensed professional before making any financial or investment decisions. Remember, I am just some random person on YouTube, and I could be completely wrong. Now, with that out the way, today's video, I've done a deep dive on this already. Perhaps I got it wrong, and a lot of people have been mentioning XPAY again. On almost every single video, there's someone mentioning XPAY. I did a deep dive on it about 3 weeks ago. I went over it, and perhaps I got something wrong. Maybe I'm missing something. So this is Due Diligence Part 2, XPAY. Did I get it wrong? We're going to go deeper into the mechanics, the risk, and the reality of that 20% target distribution. We're going to be looking at the structural analysis, bull market test, and my final verdict. All right, the thesis and strategic value of proposition. Right, XPAY isn't your grandfather's yield fund. Right, it represents a significant evolution in income vehicles. All right, so this is how I'm seeing it. It's a new thing. It's trying to be the innovator in terms of their thesis and their strategy. Right, it departs from yield harvesting, selling calls, and moves to a managed distribution framework. Their goal, I think, systematically convert quality equity capital appreciation into high velocity tax efficient cash flow. The mechanism they're using, their target is 20% annualized distribution paid monthly. Their base is calculated on NAV as of the prior year end. Their tax goal, categorize distribution primarily as return of capital, ROC. Right, this transforms the proposition from income generation to tax deferred withdrawal. So I think this is what they're aiming for, what they're targeting. How it works: the synthetic long, unlike peers, which JEPI, XYLD, XDTE, that caps your upside to fund distribution, XPAY does something differently. Sorry, that was my phone. If I'm wrong, let me know. So this is how I'm seeing it. This is how I think it's working. Okay. They use flex options. All right. Utilize deep in the money flex options. Their delta is about 1, so it moves along with the market. They create a synthetic long position. You get nearly full participation in S&P 500 upside. However, you also get the full downside because of that delta. That's the warning here. This exposes you to the full downside risk. No premium buffers here. So I think this is how their strategy works. Correct me if I'm wrong. This is what I'm finding. This is the information I'm getting. My verdict and suitability, right? Rated, I would say it's structurally robust, but it requires strict suitability parameters. The primary use case for this: optimal for wealthy investors or retirees seeking to monetize a bullish S&P 500 view into monthly cash flow without triggering immediate taxes. So what I mean by this is that you're already a you have multiple assets, right, outside of the stocks. You're a high income earner, or you're already retired at the retirement age. I'm gonna say at least 55 plus. This would be the best use for this ETF, in my opinion. The secondary use case: tax planning tool. Defer taxes until eventual sale. Convert ordinary income into long-term capital gains via cost-based reduction. But here's the kind of the worst cons of it, right? XPAY is not suitable for investors seeking downside protection, risk-adjusted yield. Its volatility mirrors the S&P 500. So in a bear market, the distribution policy accelerates principal erosion, right? So that turns into destructive rock. My key due diligence findings: the performance year to date has been about plus almost 17 for the NAV versus S&P 500, which is plus 17.56. So it tracks very closely. The lag is due to the 0.49 expense ratio and cash drag from Collateral, so I factored that in. Distribution fidelity consistently met the 20% goal, paying approximately 0.95 cents per share monthly throughout 2025. So payout has been freaking amazing. Liquidity, 63 million assets under management, small but supported by SPYI liquidity. So that did put a red flag for me. However, because it's doing flex options, it was a little bit better. It's not SPY in itself is trillions of dollars, so we had no worries there. Right, the secondary spread averaged a manageable 0.11%. The risk profile, no downside hedge. Right, April 2025 drawdown, it dropped nearly 20%, identical to broad markets. So that is something you guys have to factor. Right, this is my key due diligence findings. If you guys did your due diligence, if you're investors in this, let me know what you think of this. Is this new? Is this wrong? Is this correct? Are you okay with it? Am I saying the right things? Right? Are you already a wealthy investor and or you're already at that 55 plus age, right? Because if you're younger than that and you're just paying the game for this type of payout, it might not work out for you when there are better risk adjusted ETFs, in my opinion, of course. All right, the target 20 distribution mechanism, right? This is the central pillar. Unlike corporate dividends based on earnings, this is the mechanical calculation. So this is how I came. This is exactly how I came out with, how I do my illustrative scenarios. Like I kind of base it off what it pays, what it's tracking. So I kind of look at the historical data. So I use December 31st NAV, closing price of last year times 20% fixed rate equal annual payout locked for the year. So this is just kind of like you're able to forward guess what it's gonna happen and how it's gonna track. So operational reality for 2025, this resulted in a fixed payout of roughly 0.95 cents per share every month. This amount is fixed for the calendar year regardless of market moves. The dynamic payout ratio, a crash scenario, if market drops 20% in Q1, that fixed dollar amount becomes a higher percentage of remaining assets, right? Accelerated depletion. The rally scenario, in a bull market, effective yield on current price drops, allowing you to retain more capital. So, of course, this is kind of my scenarios. I think this is how it's going to happen. If you own it and if you've seen it do things differently, let me know. Because, again, it makes my videos better and my scenarios sharper. So, of course, if you're not seeing what I'm saying, let me know. All right, the synthetic long structure. XPAY doesn't hold the 500 stocks directly. It uses flex options on SPY. That is why I'm saying it's synthetic, right? A lot of people say, oh, it's not synthetic. But when they use flex option, that is considered a synthetic position, essentially, right? Deep in the money call options, right? The strike price as low as 0.01, economic equivalent of acting as a surrogate for the stock, virtually zero time value. The delta is 1.0, move dollar for dollar with the SPY. Y options, cash flow management, right? Holding physical stocks will require selling fractional shares of 500 companies monthly, which is, a transactional nightmare. Options allow efficient liquidity management and optimize tax characterization. That's why I think they do this. All right, the collateral wedge, right? Buying deep in the money options require less cash than buying stock. What happens to the rest? I believe they're holding in treasuries. This is the facts that they're saying. It's that treasury holding is about 14.5%. So I'm assuming that's what they're doing here. Invested in FGXXX and US T bills. Function 1, liquidity, right? You're getting interest. The fund is getting interest for it. And if it doesn't do well, then they use the interest to pay you out or to support the NAV, however they want to do this, or buy more or create more synthetic call options. And so function 1, ready cash for monthly distribution without disturbing core options. Function 2 is the yield floor, contributes 60 to 70 basis points to total return, helping offset the expense ratio. Right, flex options analysis, right? Understanding the engine room of XPAY, right? Flex versus standard. Standard options has rigid date and strikes. Flex allows customization. XPAY uses to set strikes at exactly 0.01 and align expiration with operational cycles. So you, for the most part, you guys just have to understand what flex is. It's just the synthetic part, right? They create their own. I say you don't have to worry about it. But if you do, I don't even know why you're watching my videos, right? Because when you're using flex options, that means you are a ultra high net worth individual. And when I say ultra high, I think I'm talking about like 50, 60, 70, 80 million dollars to play around with, right? The big boys use flex options. So that really, we just have to know that how much they're paying it for. That's all we should care about, right? Otherwise, flex options, the hedge funds sell it to other hedge funds, buy from other hedge funds, or these funds sell it to banks, or they sell it to ultra high net worth individuals who have that type of money to go to the market makers and say, I have $80 million. This is what I want it, to do. Like you're someone like Warren Buffett, like, right? I want it at these strike prices at this certain amount at this time, at this many shares. So if you're at that level, you can give me a small loan of $1 million, right? 0% interest. Anyway, the counterparty risk, right? Crucial here is to look at the flex options are cleared through the OCC, right? The options clearing corporations. This mitigates the risk found in OTC swaps. The OCC guarantees performance. Basically, it's just liquidity. It's just saying, if you're a buyer, there's a seller. If you're a seller, there's a buyer. Right? Structural trade-offs, right? The dividend trap. Holders of call options don't get dividends. I think a lot of people have to understand the difference between premiums and dividends. They're not the same. XPAY forfeits the 1.3% SPY yield. However, the option pricing model discounts the call price to account for this. The net effect, funds capitalize dividends into price appreciation, putting more pressure on NAV performance. So what I mean for volatility sensitivity, deep in the money calls behave like stock. They have low vega. XPAY is an equity risk product, not a volatility product like XDTE. Right? Analyze based on your S&P 500 price outlook, not the VIX level. So XPAY does not care about the VIX. And if you've been a subscriber and a viewer of my channel, right, a lot of the cover call ETFs depend on the VIX, right? What is the VIX? The VIX is basically determining how fearful or how greedy the market is, right? The more fearful the market is, typically that means the more expensive the premium is. However, XPAY does not care about the VIX level. They specifically look at the S&P price outlook. So it moves along with the S&P 500. There's good and bad, right? I'm not saying it's one over the other is good. It just depends on, well, how old you are, where you're at in life, how much money you're making already, right? So it just depends on your portfolio landscape, right? So of course, if you're semi-seasonal or seasonal investor, this might be for you too, right? For the rookies, probably not, because this is a little bit more complex than a basic cover call ETF. The economics of return of capital, right, is not just giving your own money back, is a deliberate feature. Constructive return of capital scenario, S&P rises 15%, XPAY pays 15%. Benefit, you get the gain in cash, but pay $0 in taxes currently. Cost basis reduced. Destructive rock, right, scenario, S&P falls 10%, X pays 20%. Your risk, your NAV drops 30%. You are liquidating principal at a loss. You create a death spiral if the market doesn't rally. And when I say rally, really rally, right? 15, 20, 30% type of rally. Right, this is just a section 19A-1 notice. Right, throughout 2024 to 2025, X confirmed it has anticipated distribution to be entirely return of capital. The warning here, I always say section 19A-1 notice or estimates. All right, final tax character is determined from the form 1099 div from your brokerage at the end of the tax year. Right, if the fund generates new investment income from, for example, from treasury collateral, that must be distributed as ordinary income. The 20% target is a distribution target, not a tax guarantee. So this is very, very important. A lot of people say, "Oh, it's 100% rock. It's 100% rock." All right, so it's not 100% rock until you get that 1099. Until you have that 1099 in your hands, printed out, ready to do taxes or give it to your accountant, it is not 100% rock. Always treat it as if it's ordinary income. That is the best method going forward. All right, the 2025 bull market test, right? Total return versus S&P 500, like I said, mentioned earlier. XPAY year to date is about almost 17% at 16.78 versus the SPY year to date at 17.56. It had tracking errors, right? Trailed by 78 to 94 basis point, caused by expense ratio at 0.49 and the cash drag. My conclusion here is tracking is remarkably tight given the complexity, so good job on that. The synthetic long strategy is working as intended, delivering near market returns. XPay versus peers. Of course, we got to compare it, right? Year to date 2025 and a bull market, XPay is superior because it does not cap upside, right? It goes 1-for-1 with the market. So if the market moves up, so will XPay, right? The strategy here, of course, like I've mentioned, synthetic long, year to date return 16.78%. Insight, best performer, captures full upside versus the SPYI, right? Year-to-date return 15.82%, lag slightly due to cap upside. SPYI, year-to-date return 12.69%, significantly lag due to capping friction. And XDTE, year-to-date return is 12.24%, lowest return, short calls, cap gains. So XPay in a bull market completely demolishes even the best of the best like SPYI. Drawdown analysis, right? We got to talk about the drawdowns. We're going to talk about the bull market. April 2025 correction dropped nearly 20%, virtually identical to the broad market. The risk reality, you must internalize this. All right, don't go in my comments saying, "Oh my God, year to date, blah 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 blah." Yes, you've been saved by a strong bull market. All right, XPay offers zero downside protection. Unlike buffer ETFs, XPay participate fully in crashes. The high distribution does not act as a cushion because NAV falls by the amount of the distribution. So let's get that straight. Yes, a lot of you guys been like, XPay's been doing well, it's been doing well, it's been doing well. It even done better than NEOs. Of course, we are in a very, very strong bull market. And like my previous slide, like I said, it has demolished even the best of the best. Because we are technically still in a strong bull market, and that's just year to date. But if you want to do all of total returns, that's a whole different story, right? So again, we can't really compare XPay to others just because in terms of total return, right, it doesn't really matter with the it doesn't go with the VIX, right? It goes with the S&P index tracking. So that one of the major differences there. Anyways, back to my point, back to my video. All right, portfolio composition details. As of November 28, 2025, the fund demonstrated a laddered strategy, right? Look at the top options positions here, right? All right, why laddering? Diversity prevents the fund from forcing a row of the entire portfolio on a single day, right? That prevents disaster during a market dislocation. So here, they're using the laddering strategy just so they don't have to completely destroy all of their top options positions. Structural vulnerabilities, right? The NAV death spiral. If 50% market drop plus 20% payout equal catastrophic capital reduction, right? Mitigation, annual reset mechanism drops payout amount significantly after a down year. Tax uncertainty. IRS cannot characterize flex strategies as straddle or constructive sell. This would convert ROC to short-term gains and or ordinary gains at almost 30%, 37%. And then, of course, liquidity, reliance on deep in the money flex options create dependency on the OCC and market makers. A flash crash could widen spreads dramatically. Hasn't happened yet, but it could happen. Always be aware of that. All right, understand your managers, right? I always try to put this type of information if I can, especially if I'm doing a new deep dive. However, I don't think I put this in the other video for my part 1, but part 2, right? This is my deep dive. This is just understanding who owns it, who runs it, who's the sub-advisor, who's the custodian, the credibility behind these ETF, your strategy. Maybe you know, maybe you don't. So I know a lot of people, I mention this because I know a lot of people don't want anything directly or indirectly related to YieldMax. It doesn't matter who it is. If it's an ex-manager from YieldMax, they don't want to touch it, right? So they don't want anything directly or indirectly dealing with YieldMax. So understand your managers. All right, the who is this for check. Who should buy this? Again, this is my opinion, right? From my deep dive and what I understand of it. Who should buy it? The income-dependent bull, right? Retirees needing cash flow, but bullish on the S&P. High-tax investors, 37% bracket, right? Return on capital, 0% tax, better than ordinary income. The estate planner, right? Step up in basis, wipes out deferred tax liability upon death. And I've made a video on that on step-up basis. If you just go on my channel and type in the return of capital on pretty much how to never pay taxes, I have a video on that. All right, this return of capital is a great way of generational wealth building if you know how to use it properly. I have a personal accountant. If you can afford it, if you can pay for it, if you can at least build a relationship, right, have a personal accountant, right? So a lot of these things I'm not going to get too much into it just because I feel, like I said, I'm not a tax professional. You should hire one, talk to one. Yeah, who should avoid it? The yield chasers, right? Think 20% is risk-free. Coupon will panic when NAV drops because it goes 1-for-1 with the market. The accumulator, young investors like myself, I believe paying fees to get own money back is inefficient. At this, I don't want to go 1-for-1 with the market, right? I want to kind of have that downside protection, and I feel like since I'm holding on a super long term, I want that VIX. I want the cover call ETF to track the VIX instead of the broad market. All right, so in my opinion, I just don't think it's good for us. Maybe if you're willing to take on that risk, I don't know. And of course, the bear looking for protection, look elsewhere. I don't think XPAY offers it. Like I said multiple times in this video, it goes 1-for-1 with the broad market, and if it drops 15-20%, so will this, and it still has to pay out that 20%. And I didn't mention this, but for the young investors, if you, I think it's in their perspective that they even mention it, right? XPay is, I want to say when I read it, I should have put it in here, but XPay is explicitly marketed as an income product for investors who want a predictable, tax-efficient cash stream and is comfortable with principal erosion over time. I think they've mentioned that, right? So that's the reason why it fits pre-retirees or retirees funding that's already that they're using the funding to live already. I would say at least 55 plus. For those who are 55 plus, this is like the perfect stock, right? So no, that's another reason why. All right, future outlook scenario. Again, these are my scenarios. These are my guesses. I could be completely wrong, so don't give me too much heat for this, right? So my future outlook for scenario A is the roaring 20s, like the 1920s. The market is just boom, 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 up, 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 up. Never stop, right? Bull market plus 15%, total return plus 15%. Investors enjoy massive cash flow and deferred taxes XPAY excels. Scenario B, stagflation, which we might be entering, right? A flat market at 0%. NAV erodes by 20% annually. Fixed payout on a shrinking base destroys value. XPAY, dangerous. Get away from this. Scenario C is the crash, right? The bear market, boom, drops 30%. NAV drops 30% along with the market, plus a 20% distribution rate equal a 50% drop. You are a completely leveraged downside here. So this is my scenario again. This is my guesses on how it's going to operate based on the perspective and their strategy, the way they're using the options. This is what I'm seeing. Again, I could be completely wrong. For those who've owned it since inception, let me know. I mean, am I wrong? So I will definitely go ahead and fix this video. Alright, my final verdict, right? XPAY is a financial engineering fee. It packages a systematic withdrawal plan into an ETF wrapper with favorable tax characteristics. Buyer beware, this is not income. It is 100% return of your capital, as they've stated. They've mentioned it themselves. As long as you understand it's a tax-efficient mechanism for self-liquidation, it is highly effective. Right, that's a buy. If you understand that, and this is what you're buying for your portfolio, this is what you want, buy it. It is a good buy. Right, buy for income-focused satellite portfolios. Avoid for core buy and hold growth allocations. Thanks for watching. I'm not sure if they changed your mind on XPAY. Let me know below. I really appreciate you guys mentioning XPAY and trying to ask me for another video. I've done the first one about 3 weeks ago. You search for it, but this is part 2. So please like, comment, subscribe. Catch you guys on the next. Thanks for watching. Stay tuned.